The global markets are in a state of madness. Though most have ignored it, there are certain facts that can't be disregarded any longer. Trillions of dollars worth of bonds will be downgraded in a future crisis and will wreak havoc on the financial system. There is no turning back from what Dr. Frankenstein has created. It's a mess as it is, and as the wreckage becomes more apparent, this will only be magnified to a level never seen before. You came here for the truth, so let me unveil that for you. Today we are going to talk about the multi-trillion-dollar elephant in the room. That's right, this is something that nobody seems to be talking about, and yet it is so serious. And why? Because people have their blinders on. They are not paying attention to the wider picture. So of course, that's why you're here. Let's get into it right away. A large number of corporate bonds have fallen to BBB, but not to junk. What you are looking at here, nearly 50% BBB rated portion of the US corporate bond market. Understand what this means. I've talked about this before, but I wanted to bring it up in this video specifically. Do a video that surrounds this because this will be very important. It's not necessarily going to be the catalyst for the next financial crisis, but certainly there have been many around the world pointing to this issue, suggesting this is where everyone should be paying attention. So I'm going to highlight it here, and I'm just going to give you a brief explanation of what I expect to see. Right now, today, you have all these different rated bonds, and of course, we have this BBB. Now, this is above the level of junk, according to them. I suggest that it is junk. However, this is where they're at. BBB. All right. Now, they are just sitting above this line, which anything below the line is considered to be junk. All right. Now, in a financial crisis, when you have some sort of calamity or catastrophe, this is going to result in many of these bonds being downgraded, and that all depends how far down they're going to go. However, if they move down just one level, what we're going to see here is that fund companies are forced to sell them. They cannot hold junk in these cases, certain cases. So of course, we are going to see a cascading effect. As they start selling them, that's going to encounter some other problems along with all different corporations, how they're all interconnected and intertwined. This right here will magnify any crisis, no matter how bad it is. As soon as you start to see this occur, this will cause a bigger problem that might already be there. Now, if the problem is with the corporate bond market to begin with, and then you add this on top of it, it's going to be absolutely huge. But if it's just a normal event, this is going to actually create the problem and make it much worse. A so-called normal credit cycle, one that Steve Eisman referred to recently, will only be made worse by what is happening today. And why do they do this? Why go for the BBB? Why not go for the A-rated bonds? Well, of course, you're going for that yield. Right now, we are seeing the negative yields around the world nearing $17 trillion. They need to create an environment that is profitable. So this is what they do. They take the absolute risk. No, they're not going to go into junk, although the junk market, of course, has grown considerably. They're going to go one level above that. So they could say, look, we're being very cautious. We are making sure that everything's okay. But that really isn't the case. Here we're looking at an issue that is, of course, going to unfold in the years to come. I've got some more data I wanted to share with you. So let's look at it right now. The amount of US corporate debt that matures through 2024 has grown to around $5.2 trillion. Just the number there is absurd. According to the S&P Global Ratings, the lower interest rate should make refinancing the debt pile manageable despite an expected slump in economic conditions. This pile has grown wider and wider, and of course, there is a problem when you have rising interest rates. But just like the national debt, just like the deficits, and all forms of debt, in fact, this is all going to be tied to an interest rate. Now, we had seen all of these interest rates increasing, and then at the same time as this occurs, we see the economy that is starting to slowly fall. Now they're calling for interest rate cuts all around the world. They're either suggesting they're going to do it or they have already done so, beginning a new quantitative easing cycle. This right here is important because how this connects in with all of these financial instruments, they're all tied to some sort of interest rate. Whether it's the LIBOR, $200+ trillion trading on that, whether whether we're looking at inside the United States with the Federal Reserve Fed funds rate, understand how important what central banks are doing really is in this next financial crisis. Take a look at this, the global investment grade fixed income. All right, so you get basically two columns on the left, two columns on the right. What we're looking at is the non-USD versus the USD. I wanted to show you something. If we go here and look at the US debt, we're getting a yield of 1.59%. However, if we look at the non-US debt, it is in the negative. Now, it's just barely in the negative, but the point is made. Minus 0.03. That's the yield you're getting if you go outside of the United States on these sovereign bonds. Where do you think the money is going to flow into? Of course, even though the USD bonds are showing you very low interest rates, people are going to pick them up, and that's just the way it is. Taking a look all around the world, we can see the same type of patterns, and that's not a good thing because all of these financial instruments are really relying on higher interest rates. You need to know that, not lower interest rates. Certain types of businesses need to borrow money. However, if they're lending out and trying to make money off of the spread, if the interest rates are rock bottom or they're negative, they can't do that. That's what we are seeing in Europe right now. With these negative interest rates, it is putting a burden on the banking system, and look how terrible they are doing right now. They're back to the level they were before the financial crisis. That shows you how affected these companies are with these very low or negative interest rates. It's not a good thing. People see it as a good thing, but of course this has a major impact. This chart here, I wanted to compare the red line and the green line. The green is the MSCI World Index, and then the red line is the Global Manufacturing PMI. Take a look at this. If you have been paying attention, you can see that we have yet to surpass the level from January of 2018 when we're looking at the whole world. That's not a good sign. Many have suggested that we are now at the early stages of a recession, but because of the United States, it has kept it afloat. That is not a good sign. What has happened here is that all across the world, we have watched manufacturing declining and so many other statistics that I've covered here repeatedly on this channel. The whole trucking environment is in a recession right now at this moment. Look at what's going on in India. Look at what's going on in China, in Hong Kong, everywhere around the world. There's something that is disruptive and has been a complete 180-degree spin from that which we saw in, let's say, 2017, where everything was growing and this supposed perpetual boom would be maintained forever. Not what's happening today, right now in 2019. That is for sure. 2018 was terrible. 93% of assets globally were very weak in the negative, and now we have the next level of that here. The weirdness in financial markets at the moment seems boundless. In the past 2 weeks, the proliferation of negative yielding bonds has erupted. 30% of the global tradable bond universe is being sold with a guaranteed loss attached to the coupon. That's an eye-watering $16.7 trillion worth. Understand the absurdity as to what we are dealing with right now. The numbers are shocking, but when you understand the repercussions of all this and how it can't be pulled back, it can't be reversed, that's when we really start to feel the burn. There are some serious changes that are going on right now, and I wanted to get into some of those here at this time. The FDIC on Tuesday voted to approve a 5-agency revision of the post-crisis regulation known as the Volcker Rule. The tweak would help clarify the way in which banks trade securities using their own funds, the ban of which was a key portion of legislation from the post-financial crisis bank crackdown. We'll see what comes out of this, but usually in all of these cases, the actual main factor isn't important. It's what's in the fine print, what they sneak in under the radar that always happens to occur. Most people have no idea. They just read the headlines. But when you look at the deeper details, you find out some very strange things that were put through and approved because the lawmakers always sign on the dot. They always allow everything to pass and they never ever read the bills. And it's partly not even their fault because they're given an extremely short period of time to sign bills that are hundreds and even thousands of pages long. How in the world is this possible? But of course, that's not the way it works. They are simply just signing on the dot and they move on. A strong majority, 74% of US business economists appear sufficiently concerned about the risks that are currently present and expect a recession in the US by the end of 2021. They're cautious to say the year 2020, but here 74% are saying by the end of 2021. Of course, that is far out into the future. The question I have is, what exactly will be the catalyst? They don't necessarily talk about anything that they believe will trigger the events, but here we are today, at least getting the admissions from some individuals that there will be some sort of crisis in the future. They will all whitewash it. They will all suggest that this is no more than a normal credit cycle, but there's more to it than that. I don't like to focus too much on this because these predictions often don't tell you the whole truth about the situation. Then look at this. A recession dashboard from Credit Suisse indicates the economy is nowhere near a recession. So depending on who you ask, they have a completely different interpretation of the data. They showed you this recession dashboard. I will give it to you in just a second, but I wanted to give you the outline here. The firm tracked the state of certain economic indicators at the start of each recession dating back to 1973. Currently, the yield curve is the only economic indicator pointing to a recession. And this is it right here. Well, the highlighted one at the bottom is the present. And you could see it's either up or down or sideways, just to give you an idea. Looking at this in comparison to the events that we have seen historically. December of 2007, basically everything was down except job creation was flat. This time around, they're pointing to how everything is fantastic. So Credit Suisse, I want you to actually look at some real data for once, if you don't mind. But look at this. PIMCO offloads ultra hot bonds after rally. We're a lot more defensive. Even if we get a narrow trade agreement between the US and China, we could see a pretty powerful snapback in yields. When a massive company like this is taking these steps, taking these actions, everybody should be paying attention. They shouldn't trade based on it. They shouldn't actually put everything on one particular company or one person. Don't follow Warren Buffett. Don't look at any of that, but take this in as one simple indicator among the hundreds and hundreds that we talk about. Look at what the big boys are doing in their actions, not their words. JP Morgan's trading guru says stock rebound to continue, yield decline not based on fundamentals. You don't have to worry because JP Morgan said that what we're looking at right now is fundamentally not a problem, therefore stocks will increase. This individual here was bullish in October of 2018, bullish in November of 2018, completely disappeared in December of 2018, and then reappeared at the beginning of January, telling everybody that this was a bull market. Well, of course, anybody could do that. The fact remains, when you look at the risks that are apparent, isn't it wise to simply be less aggressive with the way that you invest, that you should maybe pay down debt, that you should look at things a little bit differently, that you should hold more than one asset class? I think so. However, most simply do not. That's all for this video. If you found it informative, hit that thumbs up button. When you hit the like button, you're supporting me. I do appreciate that very much. If you want to know how to build a business, I created an entire course called the Amazon GPS. It's a free e-course, completely 100% free, teaches you how to make money on Amazon, the strategies you need to create a passive income business, step by step, show you everything you need to know. There's a link in the description, and that is theamazongps.com. If you want the financial education you weren't taught in school, these 2 books have everything you need. All the details from A to Z. We're looking at making money, reducing your debt, tax incentives, and so much more. Definitely check them out at the link in the description if you want the audiobook. That's available at themoneygps.com. Wait a second, hold on, don't go anywhere. Have you watched this video yet? It's huge. Definitely click on it and I will see you over there.